Joining us now is Jason Furman, former White House Council of Economic Advisors chair, along with former Federal Reserve Board Governor Frederick Mishkin. Guys, welcome. Rick, you think the Fed should have hiked today, unlike unlock, it sounds like, but CPI was cool, PPI was cooler, commercial real estate issues perhaps loom. Why do you think the Fed should have hiked?
I think it's true that CPI has come down a lot, but the core inflation and sticky price inflation has been slower to come down. And the bottom line is the Fed's still a long way away from the 2% target that they've announced. And it's very important that they have credibility to keep inflation at that target. And also the economy is still much stronger than people expected. So on all these levels, my view is that the Fed is going to need raise rates. And my view is better to just to do it at this meeting. Why? Because the Fed actually got behind the curve. And when you get behind the curve and inflation goes to very high levels, you really want to convince people that you're serious about keeping inflation under control. That actually affects inflation expectations, leads to better performance of the economy. So I think it's not unreasonable that the Fed decide to pause to wait for some data. And I wonder, they say the banking sector is all in great shape, but I think there may be some concerns there that is causing them to do the pause. So, you know, I tend to think that it's a judgment call, but I would have judged a little differently.
And Jason, it sounds like you also think there's a risk here of the Fed getting behind the curve by not hiking. Is the market in not only not believing that the Fed should have hiked today, but not believing that the Fed plans to hike a couple more times this year, therefore completely misreading the situation in your view?
Yeah, I mean, the market's optimism over and over and over again is just amazing to me. It's just the same mistake over and over and over again. I agree with everything Rick said. I would have made a different judgment today, but I don't think it was terrible what they did. But they very clearly said we're data dependent. They raised their inflation forecast. They lowered their unemployment rate forecast. So what does that mean if you're data dependent? That means you have a higher terminal Fed funds rate. And they did that too by 50 basis points. So I think they couldn't be clearer. Occasionally they miss a beat, but they catch up a month later. And anyone who thinks otherwise is just going to be unpleasantly surprised.
Rick, I mean, you've been in the room before. You're former Fed governor. When it comes to the decision-making process, when you see this big upward revision in the dot plots and the fact that there's now so many different officials that everybody seems to think another hike is on the table, but how many hikes? There's a big divergence now. Just want to get your thoughts on that and how to understand it as an investor in terms of messaging and signaling versus how likely it is that we could actually see multiple hikes come to fruition.
Dependent too. And as Jason has pointed out, there's the numbers are not looking like the Fed doesn't have to raise rates more. I actually thought that the Fed had to raise them to 5.5% a while ago, and yet, if anything, the economy's been stronger than I expected. So, I think it's you'd like to be optimistic and hope that the Fed doesn't have to raise rates, but on the other hand, the data is not actually convincing me that I should have changed my mind. If anything, it's moved me a little bit in the direction of saying that the rates have to be even a little higher than I thought previously.
Yeah. Jason, I mean, a lot of talk about the labor market as well in the conference. What is it going to take to see actual core inflation, quote unquote, using Powell's word, decisively move down? What is it going to take for us to see that labor market actually loosen up enough to have an impact and do that?
Look, I don't know the exact answer to that question. I think the further down you drive inflation, the harder it gets. We've done the really easy disinflation already. If you've gotten the unemployment rate rose to 4.5%, which is what the Fed has penciled in, I think that would help get inflation down. I think that'd be very unlikely to get inflation down to 2.0%, which the chair said was his goal, although I'm not positive that ultimately should be the goal. I think ending up a little bit higher than that might be just fine.